Hey guys, Mike here. So, oh boy, what a day in the market. It's been a while since I said that, but it was just kind of one of those days, right? We got data released this morning, we got earnings released, and we're going to talk about Tesla, Taiwan Semiconductors. Obviously, you saw what happened to Tesla, but the biggest thing was Taiwan Semiconductors, which was a shocker, and that is the granddaddy of all semiconductor companies, okay? And I'm going to explain to you the importance of the company and why what they said actually matters, even though the market was like, whatever. And I'm going to show you their chart because we touched on this yesterday, I think, or the day before about something to watch out on charts, and oh my goodness, you definitely got to watch that one. But we had a lot of data come out today, so we'll get into the charts. But I'm going to start off with what hit the market this morning, right? And this is what I put in the morning news brief, so I'm just going to put it out there to you from here. And obviously, earnings were weighing on the market, but more importantly, the Philadelphia Fed Manufacturing Index report, which I told you to watch out for this. We had the Empire Manufacturing report come out the other day. I told you it was all hunky-dory, but I said let's pay attention to this one more because the market tends to pay attention to this more because they have a lot more manufacturing. And of course, it came out not good. Fell to negative 31.3 overall in April. Lowest since May of 2020. By the way, we shut down the world in 2020, so it's not good, right? So it went down from negative 23.2 in March, so it went down even farther. That's 8 consecutive negative readings, and so not a good thing. There was some slowing, which was actually good as far as like the numbers being bad when it comes to new orders, things of that nature. But overall, not so great. Plus, oil, of course, hit another skid because they're worried about the slowdown and stuff. So that's got people worried. So that definitely weighed on the markets. And you can see by the chart here, very easy. You just look at that blue line right there, and you can tell, obviously, it's falling off a cliff. Okay, and then if we draw a line over to see, really look at other years compared to this, you can see it's getting down very close to that 08 level. The only thing that's not falling as fast is what? Number of employees. And so that right there, because why? We have a labor shortage. That's just the way it is, right? And so that's the whole hang up with all of this stuff. But the good news is, what are we? We're 70% services, so therefore I don't think this stuff weighs on the economy as much. But I do want to talk about, because we had housing data come out as well, but I'm just going to say this. Look, housing stocks are on a tear, right? And everybody's expecting this housing crash. And I've been saying for months and months and months, I don't see how you have a housing crash when you got supply this low, right? This was the supply in 08 right there. You can see, look at where we're at now. You just don't have enough houses for enough people. They are building a lot of apartments now. That's actually something that's being built a lot. When it comes to houses, especially in the state I live in, there is not enough inventory to even think about having some kind of massive crash. And with over 50% of the mortgages being created in 2020, or most of them are below 4%. Yeah, I mean, again, if we have some massive layoffs, you're going to see people losing their houses. But remember, the 08 crash was because of the predatory lending and all the bundling of the mortgages and stuff and all that hot mess. That was just different than what we're in now. Okay, so just keep that in mind and let me know what you think down in the comments. Now, the next one, I'm just going to update you on this one when it comes out every time. It's the Conference Board Top 10 Leading Indicators Index. And basically, they say it has a 100% win rate for pointing out recessions when it hits this stipulation. You can see it's below the zero line. That's one. It has to be below there for 2 months or more, which of course we have been. And so when you look at that, all these other recessions, they hit the same stipulations. And so just keep that in mind. I'm just updating you. I'm not saying this thing is going to be accurate or not, because right now you would think we'd already be in a recession right now. But because, again, of the employment situation, that is just not the case, and all the extra money we still have in savings, okay? Now, that leads me into an interview, which I always try to bring this guy wherever he talks, and that's Jim Carson, I believe is how you pronounce his name, which I finally figured out. And he's a gentleman that manages volatility index. And what we talked about, the VIX being dead. Well, of course, the one thing he touches on is people keep saying, well, how come the market's not going down and it's not rocketing up, right? We kind of, especially the Qs, is just kind of trading sideways right now. The S&P is inching up, right, and trying to power up to get through certain levels. But, you know, he's asked, is it the options market? Is it liquidity? Like, what is it that's causing the market to act like this?
It's the combination of both, right? From the top end, there's a lag, right, from monetary policy. We've done 5%. It's still working through the system. It takes time for monetary policy, particularly interest rate increases, to run through the economy. There's $450 trillion of long assets, about $50 trillion of U.S. equities. The other $400 trillion, right, operates on a massive lag. Private equity, venture capital, real estate, all of these take time when interest rates go higher. Even the equity market, buybacks, right? $50 trillion market, those buybacks have been at record levels, the same as the last year. It's only next quarter, this quarter, the next quarter, that you start to see this really falling off. And that change in demand as these interest rates work through liquidity in the market really are what matters. So there's that overhang, right? This is what I've been talking about, the Fed selling calls. It's still out there. The Fed is still, working liquidity out of the system. All the while, everybody sees this coming, is getting short, is trying to get in front of it.
They've been getting burned.
And they get burned, right? Because reflexively, if they're short positioning in the market, people are under allocated, that means that short gets squeezed. That it is never easy to short a market by definition. This is why 1999 happened before 2000. This is why 07 happened before 08. This is why even on a micro scale, we knew about COVID in early January of 2020, and it took a month and a half of a blow off top for a decline to happen. This is how markets work.
And that leads us into this right here. We had banks report, right? Well, what are they doing? Remember, they actually reported really good earnings, but the market's not really reacting off of it. And why? Because of the amount of bad debt they're starting to write off. And they wrote off $3.4 billion in the first quarter. And you can see by these charts what's happening when you saw it was in the negative going up. What do you see with these trends? They're all trending up, right? These are the major banks. And remember, who does so much of the lending when it comes to commercial and things like that, which is even in much more trouble? It's regional banks, right? I mean, they do more of the commercial side, which is the one everybody keeps talking about. And so if these banks are right now $3.4 billion in bad debt, come into the future here, next 6 to 12 months, when these commercial loans come due to be refinanced, and they got to refinance at higher rates and all that good stuff, you can imagine what's going to happen. And with all of that said, this is why you see, this is the dumb money, smart money indicator. Smart money, which is the big giant orders, have been selling off into strength. And of course, dumb money with small orders has been buying up, right? Which is still making money because the market's going up. But big money tends to sell into strength and then buy into weakness. And before we continue, guys, if you're getting anything out of this, please hit that like and subscribe button. Think about sharing the video with your friends and family. And if you're new here and you like the content, please hit that subscribe button. I really appreciate it. And so let me know what you think in the comments about his interview, what he had to say and everything, if you agree or disagree, and what your perspective is. But that's why when Brian was asking in the comments, hey, what's the biggest risk to the markets? What nobody knows. That is the liquidity part, right? Because it is all these rate hikes and everything else, the tightening of the banks, it is super delayed. Even Jerome Powell said, even when they freeze rates, when they finally pause, right? Don't mean the market ain't gonna go up. It usually does when they pause, right? But when it comes to the economy part, because the banks, if they keep holding those rates, they will continue to tighten. He expects that to account for just like 1 or 2 more interest rate hikes that the Fed would be doing, right? That's what he's expecting. And so keep that in mind. It just takes time to work its way through the system. And because, like we said, and you know as well as I do, there was so many zombie companies created in 2020. You see the bankruptcies going up. They're going to continue to go up, especially those companies, and especially high-tech companies, which aren't profitable. They have to be able to get funding, right? And so, and these rates and everything, it's going to be interesting to see. So that leads us into the charts here, okay? And the S&P, we talked about yesterday, I want to see it test that trend line. So it did test that trend line, and it broke through it. The MACD looks like it wants to roll over on the daily and stuff. We go to a smaller time frame. You can see it did break through, started heading back up. So we'll see if it can get back above that trend line and back into that resistance zone. Again, it's a very heavy supply zone for it, right? Where a lot of people are willing to sell and not buy up there. And if we look at tomorrow, I was kind of curious to definitely see what max pain was. It drops all the way to 405. Can't imagine that's going to happen. But, when you look, you got puts at 410. You're sitting there, which of course was my daily move of the day, right? And then 415. So they can keep us right there. Market makers would be perfect to keep us right there in that small range, because that's been happening almost all week except for today. So it wouldn't surprise me a bit. Just keep an eye on the 410 level, though, because the bulls will defend it with their life. Now the Qs, what it do? Nothing, right? I heard somebody say, did we lose the Qs? Look at the chart. What do you think? No, right? It was down, but it staged to come back at the end of the day as usual, right? It's still sitting right about 1.5% above the weekly expected move as far as the options market is concerned. And so we'll have to see. It just has to do with the fact that Tesla and obviously Netflix and these other companies aren't reporting great earnings, right? And so that's weighing on it. But again, it's just sitting there. Again, it's either distribution or accumulation. We're going to find out. That's for sure. Probably next week when we get big boys reporting. Now, here's Tesla, and you can see major gap down. Horrific day for it after earnings. And, you know, if you look, it's only for that gap below to fill and everything, it'd only be like almost 10%, right? So, you know, let me know if you think that gap's going to fill. And then, of course, I'm going to go ahead and put another gap in because obviously we had a big gap down today. And so when you look at this now, here we are, 3 unfilled gaps, obviously, one in the middle, one above, and one below. So let me know in the comments which one you think is going to get filled first, because you can see on the shorter time frames how oversold we are right now. And you know dip buyers love to come in on Tesla. And I'm not sure, you know, if it was a sign or something, but obviously I don't know if you saw the shuttle for SpaceX blow up today. And so that's kind of represent what the stock did today. But, you know, Elon had a tough 24 hours, you know, lining all his billions of dollars. But if you look at tomorrow on the options market, you see massive amount of puts at 150. Definitely going below that. There's 160, which is right below where we're at now. And then you got, you know, hardly any calls sitting between like 160 and 174-ish. And so I could definitely see a pop up, you know, I mean, for the short term at least. I'm not saying for the long term, but, you know, short term for sure. Because again, Tesla is a very traded stock. And so, again, one of the most shorted as well. So shorts are loving life today. Now, Taiwan Semiconductors. I want to talk about this. And first, I'm going to look at the chart. And I told you yesterday, I said, the one thing you don't want to do is leave behind a bunch of gaps. This thing right here is the king of the gaps. I'm going to click on this filter right here. Look at the gaps. I mean, look at that. That is a whole boatload of gaps all the way down. Oh my goodness. So if 90% of gaps fill, man, they got a lot of gaps to fill. So if there is a turn down in semiconductors, boy, you know, it's got a lot of them to fill. I mean, I haven't seen that many gaps on a stock in a long time. But the important thing is, and pay close attention to this, like I was telling the members, so what they happened was they reported earnings, and they said revenue could fall as much as 16% in the 3 months to end in June, as the weak global economy and high energy prices weigh on demand for customers. Pay attention to the customers here. This is the important part, right? So they're expecting about $2 billion less for the second quarter, even though the stock, by the way, was green. Totally ignored this while other semiconductors sold off. But the important part about Taiwan Semiconductors is they don't sell to me or you. They sell to companies like NVIDIA, AMD, Apple. So if they're slowing down, that means the demand from those companies and other companies are what's slowing it down. And so some people will look at that and they'll say, oh, well, if their demand is slowing down, that means obviously Apple ain't putting in many orders, which means Apple's customers aren't putting in many orders for, you know, iPhones and tablets or iPads and all that good stuff, right? And so, you know, just keep that in mind. I mean, they're the granddaddy of them all, and it was shocking to see them go green and everybody else go red, but you know, who knows? I mean, I guess guiding down is not a negative thing right now. But if they start to fall, there's a whole bunch of gaps. So just FYI, I know I got a bunch of alerts set on that one. Now, NVIDIA, talked about yesterday, we thought it'd have a short-term pullback. And, you know, basically why? Because it got above that weekly expected move the options market had put in. So, of course, it pulled back. And, of course, it didn't help the Taiwan Semiconducors say what they had to say. So that also helped as well. So those weekly expected moves actually do mean something. Now, Meta, expected short-term bounce, didn't get it. It got rolled up with everything else. But it is sitting right there below the weekly expected move that the option market had expected. So let's see what happens tomorrow. Usually you'll get the pullback up, the opposite of what you had with NVIDIA there. And you can see on the very shorter term time frames how oversold it actually is. So we'll see if we get a little bounce tomorrow and we can get back up into that rising wedge right there. Now, when it comes to economic data, it's going to be all about the PMI tomorrow. So let's see how the market accepts it or how it actually comes out first. And then we'll see how the market eats it up. And, of course, the big one, it is OPEX tomorrow. Okay, so a lot of options expiring. Sometimes it's dead as a door now, right? Because they just want to kill premiums all the way across. Sometimes you might get a move. We'll see. And what have you seen this week, though? The majority of the days has been what? Just this small little movement, right? Just destroying premiums. Today was obviously somewhat of a volatile day. How about that? But you are seeing, you know, little V-shaped recoveries every day. Dip buyers coming in, dip buyers coming in. So, you know, that's just, I mean, it's day traders heaven, right? That's what this is. They love the kind of price action. They didn't like Tuesday and what was it, Wednesday, but they love today. right? And it's a lot easier to do it today than it was the other day. So, you know, again, this economic data, does it look good? No. What's the biggest risk in the market? Liquidity. That's what drives the market. All right. That's why I report it every single day. I update it every day for the members. That's why. Right. You can put it on a chart. You can see what's going on. Okay. And so, you know, that's what's going to happen. And I'll put I got another part of that video I'll put for you as far as Jim's interview about that exact topic, which is going to be liquidity, things of that nature, volatility, and stuff like that, which he actually knows a lot about. So anyway, hope you got something out of it. Hit the like, subscribe if you did, guys, and I will see you tomorrow.